Yeah, we'll be doing the stock option sniper training course. But with this one, being that y'all already been in the group a little bit, I'm gonna go off for that, and I'm gonna answer some of the questions and focus on some of the things that y'all may have been falling short on, or you need a little bit of assistance on, even if it's not directly dealing with options. If you want to get a better understanding of some of the technicals or some of the fundamentals. Technicals meaning the charting, fundamentals meaning understanding what we're talking about when we're looking at uh, reports, data, when they drop in retail sales data and inflation, and when we start talking about that stuff, that's important. That's just as important as the technicals. Um, so when we get to that point in the stock options, or even if you got a question about that in the middle of it, just let me know, or let Drake know, and we'll tap in on that. But we're gonna breeze through the stock options. Sniper training. This is also in your walk. On your WAP platform where you signed up. That's where you go to take this course, and they got the questions in between each chapter to check on learning and any questions you got about any of these courses, whether it's the stock options course or the shares. Just ask us. We'll tighten you up on everything. So let's get started, man. We're not gonna read word for word, but we are gonna go over. We're gonna introduce you to stock options, which some of y'all have a idea, a pretty good idea of what that is. You should, if you've been in a group paying attention to what we got going on, you should have a little bit of understanding what we're talking about calls and puts. Or when we're talking about understanding the market, the way that the market is fluctuating and moving, kind of in line with what I said this morning in the chat about trying to the market trying to find a fundamental story for support. It's already down. The technicals, we in correction territory in the market as far as technicals go. Usually technicals are a lot stronger for us to lean on, but right now you can't really lean on technicals like that because the fundamentals is overtaking that with all these tariffs and everything that's going on. So we'll go dig into that a little bit with understanding the market. Your risk management. This is probably gonna be the most important chapter right here, most important section, because this is what will make or break you. You cannot understand any of this other stuff, but if you don't understand this, this will make or break you. Live trading simulations. We kind of go through that. We got away from doing it live, but the closest to live you're gonna get is when we dropping the calls. I mean the plays in the group. Every now and then we will live trade. That's something that I think we should do soon, Drake, because we haven't done it with this group. Um,
Okay.
to be honest, man, now that I'm seeing that, I think we should do that with this group, just so they can see it in real time. I think that'll be good.
Yeah, yeah, yeah. I can live trade tomorrow.
Yeah, we can do that in real time. That'll be good for y'all to get an experience on. And I'll jump out. I'll come out. I'll come out the cave a little bit, man, and do a little bit of day trading with y'all. I've been chilling. I've been swinging and chilling, man. Hey, the market going crazy right now. It's on the way down. The world from the end. I just been swinging and chilling, but I'll uh I'll uh I'll get in there with y'all. Though. It ain't on the screen. Um, let's go. So, welcome to the stock option sniper training entry level. I put entry level on this, which this is the only one. The next one I'm gonna do is gonna be a little bit more advanced to where you're talking about strategies that you actually implementing in the market where you may be opening a call and a put at the same time as like a straddle. That's some of the stuff that you'll be able to learn in a little bit in the advanced level of options trading. But honestly, for right now, this is what I want y'all to be in getting a grasp of, because to be real, you should be trading shares, buying and selling shares, playing the buy and hold game, which is really what I'm playing right now. I'm playing the buy and hold game, and I'm swing trading. I'm not playing a lot of those short options right now because the market's so volatile that I've already taking some L's on my long positions that I was in. Hell, everybody has billionaires, millionaires, anybody that's playing this game. They done took some L's over this last month, including the entire market. It's been down. We got down over 10%, which is correction territory. So you got billionaires losing billions of dollars right now. So I can't complain about losing a couple grand. Um, but we'll get it back. The market has never come down and not recovered. So we'll get it back. This entry level, we're just getting started. Um, Everybody on mute. Let me see if I got the chat up. Just in case y'all ask some questions, I want to have the chat up.
Yeah, the chat. Yeah.
I gotta get it up on my screen so I can see it. There we go. Okay. I might going in and out. I think that was
And if
before I
y'all
got
have any questions, don't hesitate to write it in the chat. We'll, as soon as we see it pop up, we'll address it.
in. Yeah, for sure. So we can start here. What is a stock option? Basically a contract and an agreement that you have with the market to you're not obligated to buy or sell that stock, but you have that option. The contracts gives you an option to buy or sell a stock at that strike price. That's why you pick a strike price. Let's say you got Apple 150 calls. You're agreeing. You have a contract agreement with the market that you believe that stock is going to go up in price. And if let's say Apple is at 149, those are pretty much at the money calls. And once that stock price goes up to 151, 152, you still have that agreement with the market to buy those shares at $150 per share. Each contract gives you the leverage to control 100 shares. So if you did want to execute that contract, you would have to buy 100 shares at $150 per share, which majority of options traders are using these options as leverage just to allow them to gain value and then resell them to the market at a higher value than what you bought it at. That's how you make a profit. So when you're in a call option and the closer you get to the money, the closer you get to the actual price of the stock, the more expensive those contracts going to be, because it doesn't have to move too much for those contracts to be valuable. And by valuable, I mean if you got $150 strike calls and it goes to $160, that means that you can buy 100 shares at $150, which 100 times 10, that's $100. So that contract, they usually aren't one for one. It probably will gain, like, let's say $90 in profit. That's what you'll be a profit, close somewhere around there once that stock reaches about 160. But once it keeps going, let's say it go to 180, now you about $200 in profit, somewhere close to it. You'll probably be like 190. But once you get to buying 2, 3, 4, 5, 10 contracts, that's how that money starts turning into from $200 off one contract to $2,000 off two contracts, and the stock don't have to move as much. And that's what we're doing when we're trading options. That's the whole deal with trading options. You're buying it at a value, at a certain price. You're buying those contracts at a certain price, at a certain premium, and you're looking to resell them at a higher value. That's the whole, just black and white. That's the whole deal with options contracts. That's what your goal is. Now, once you get heavier in the options and understanding what they really do, you can start leveraging. Not leveraging. What's it called? I forget the
You know,
word.
selling options.
No, not selling them. When we're expecting the market to come down some, and we might grab some puts. If you got a nice size amount of shares, a nice size buy and hold position in shares, let's say you got 100 Apple shares, and we know we're gonna be going through a rough patch in the market. Like now, you can get puts on Apple out to June, and you can let the market fall a little bit and be making money off of those puts. Because just like you got a call saying that the stock is gonna go up, if you grab 150
Hey,
puts, what's up?
oh no, my bad.
If you grabbing 150 puts and it's coming down, yeah, your stocks are coming down with it, but those contracts you gaining value on. And then later on, maybe like later on in March around this time or April, you selling those contracts to take that profit, and you can go and buy more shares as the market get ready to turn around and go back to the upside. So hedging, here you go right here. That's what I was looking for. Not leverage. You're hedging. Once you get to the point where you got those big positions in your buy and hold account, you'll definitely understand what hedging your portfolio is by buying the opposite direction, buying the puts so that you are making money while the market is going down, and then you're rolling it over into your shares. Once you ready to take some profit off the table on those put contracts, you can take that, and you can go buy more shares and lower your cost average. Um, Let me get back to the course though. I keep rambling on. Leverage options allow you to control larger number of shares. This is what I was just saying as far as the contracts. This is the purpose of stock option contracts, to leverage more than just buying shares. When you buy shares, you got control of however many shares you bought. But if Apple stock is at 130 and you buy 150 calls, they're gonna be cheap. They're gonna be cheap. And then let's say Apple pops $10 that next day, kind of how Tesla did today, ran $20. Those contracts gonna gain so much value in such short time. That's how you make money in the stock options game, in the options game. That's how you make money. Um, so you using them for leverage, and then when you become a big dog, where you got these heavy portfolios with a lot of shares in there, you use them to hedge those positions, because you don't want to sell your shares. You want to hedge that position because we're expecting the market to turn around anyway. So we hedge that position with some puts, make some money off of those, and then you roll those profits over into your shares and lower your cost average. So where if you had 100 shares that you bought at $150, when they get down to 130, if you buy another 100 shares, you're at 140 average cost basis. I'm using them big numbers because I can kind of understand where to put it at. But you're gonna start small with buying one share at a time. You're gonna start small buying one share at a time. Another purpose, income generation, selling options. Selling options, that's not nothing I'm gonna really dig too deep in with y'all. I think that's when you get a little bit more comfortable with understanding what options are. You can start selling contracts, because just like you buy a contract, you can sell one. But in order to sell a contract, just like the market is giving you the option or the leverage to control 100 shares, when you sell a option contract, when you sell a put, you have to have the capital to cover 100 shares. You have to have 100 shares worth of capital, depending on how much that stock costs, or that strike price in your account. So I'm gonna dig a little bit deeper to that in the more advanced options course. I don't want y'all to worry about selling any calls or puts, especially when you just getting started. Speculations. Traders can use options to speculate on price movements and underlying assets, potentially yielding significant returns. That's just what we were just talking about. You can kind of, if you're expecting the price to go up, and you getting a nice rally, you're buying out of the money options to lower your cost a little bit, but not too far out of the money to where, because if you buy too far out of the money trying to be cheap, then as time goes on, you're gonna lose value in those contracts anyway, because you're not gonna. It's way less likely for the stock to reach that price. The longer you go, you'll start losing value in the contract due to the time you don't have for the stock to reach the strike price that you bought. So you don't want to go too far out of the money. You want to stay close to the money unless you got time. If you buying time, like I do with those contracts I got out to September, some of those is like $80 out of the money. But you're talking about a company like Goldman Sachs, which is the bank that does all the IPOs for new companies coming onto the market. They're the ones that fund those companies. So when you got companies like Palantir and who else we seen come IPO and just kill it, Drake?
Reddit.
Reddit, companies like Reddit come on the market and kill it. Goldman Sachs is the company that makes the most in that transition. That when that company's going from nothing to what they become today, that's Goldman Sachs. That's put them in that position. So that's why I'm in those out that far. And on top of that, it's out to September. So as the market turns around and starts gaining some momentum, I'm pretty sure that I'm gonna be good on those contracts. They down a few grand right now. Actually, they up. It was up 500 today. They still down like 15 altogether. But by September, I can see those being up $2,000 to $3,000. So that's what I mean by you have time for it to make that run. You don't want to buy $30, $40 out of the money. Let's say $200 strike Apple calls, and you got them out to next week. Apple has never ran $50 in a week. That just don't happen. It used to only run a couple dollars a day, but now it will run 5 or 9 or something like that every now and then, because there's a lot more people that trade it nowadays. But it makes no sense to buy a Apple call $50 out of the money for next week, expiring next week. You gonna lose money.
Some of this, y'all, is common sense. Just go back each week and you can look at the top of your screen, whether you use the Robinhood or Webull, you can look and see how much each stock has ran for the week, the day, the month, past 3 months. You know what I mean? Like, if Apple only went up $13 in the past month, you're not going to go and buy a contract for it to go up $20 for 2 weeks. It's not going to happen. So some of this is just looking at your screen, just paying attention. That's all it is.
Call option give the holder the right, but not the obligation to buy a specific amount of an underlying asset at a predetermined price, which is your strike price. That's what we were just saying. If you got Apple calls, 150 calls, you have the obligation. I mean, you're not obligated. You have the right, but not the obligation to buy those shares at $150 a share. But as we were just saying, you typically don't buy stock options. Most stock options traders, you're not buying those options to execute them and actually buy the stock. You usually buying these contracts to let them gain value, and then you selling them for profit. Puts is the same exact thing in reverse. You're expecting the stock to go down. You got 150 puts, $150 strike puts on Apple. The stock go down to 130. You're still able to sell those. It's pretty much you have the right to sell those shares at $150 instead of $130. So that $20 gap over 100 shares is $200 in profit. Mind you, that contract is not going to gain dollar for dollar because the market has to make their cut as well. The house got to get their money, but it will be close. It'll be like 190. It'll gain like 190 in profit versus uh if you had shares, if you only had like 2 shares. For one, if you had 2 shares and they went down, you just lost money. Calls, you can make money with shares just like if you actually had the actual shares. But puts, when it's going down, if you had 2 of those contracts and it dropped $20, now you're talking about what, like 380 in profit. 3 of those or 4 of those, you're talking about like 760. You know what I'm saying? You start getting up there quick, and that's how you making money in the options game. But that's also why it's best for you to learn the buy and hold game, because it's way more forgiving than these options. Because as we get into this course, you're gonna see um, the expiration plays a major role in these contracts as well, and there's a few other factors that we're gonna go over that play a major role in the value of these contracts. It's not just where the stock price is, because I seen somebody post Nvidia call. They had an Nvidia call position last week, and it was expiring the next day, and the stock was going down throughout that day. So you're pretty much saying that you expecting this stock price to turn around and pop and blow past your call, your strike price, in within overnight. It's very unlikely that what he was expecting to happen, or not what he was expecting to happen, what needed to happen in order for you to make profit on that contract was very unlikely. So when I seen it, me knowing the market and me knowing options and stuff, I kind of knew that that contract was gonna be down in the morning. But for one, the market was already closed, so I couldn't tell you, to do anything. But that's why you gotta understand how stocks move, and you're able to understand that a lot better when you buy and sell shares, because they don't have an expiration. Stock go lower, you can buy more. Stock go lower, you can buy more. Then when it turn around, you're gonna be glad you bought. You know what I'm saying? You averaged in, because now you got 10, 20, 30 shares that you done averaged down. You done brought your cost basis down, 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 and when the stock turn around, now you making bread. Here we go. We start getting into it now. The strike price, the predetermined price at which the holder of the call option can buy or hold, or the holder of a put option can sell the underlying asset. That's exactly what I was just saying. That's the strike price is the price that you're agreeing with the market to buy or sell those shares, whether you got a call or a put. Your expiration date, the date on which the option contract becomes void and can no longer be exercised. The closer, you got to think about it. If you got an agreement with someone, I always do this one, Drake, with the footballs. Like if you got an agreement with a company that makes footballs, and you got that contract in the winter to buy these footballs at a strike price of, let's say, $5. That contract may cost you $1. Let's say, just say $1 per contract. And it's letting you buy 100 footballs at $5 a piece. But that contract is costing you $100. If it's $1 times 100, $100. Now, come fall, footballs go up to like $10, $15. You still got a contract that don't expire until, let's say, you got October contract, October $5 strike contracts on those footballs. Once them prices of footballs go up to $10, $15, you still have the right to buy them at $5. So now you like anywhere from $5 to $10 in profit per ball. You know what I'm saying? And then if 100 balls, you talking about $500 to $1,000 per contract. So where you paid $100 for that contract is now worth $5 to $100, depending on how much the football is going for in the fall. That one contract. But if you bought 3 of them contracts controlling 300 footballs for $300. When them footballs become like 10, 15, let's say they go to $15 a ball, that contract is now worth, that one of them contracts is now worth anywhere from probably like $900, $900 to $950 per contract. That's how that works with having options contracts. You buying the option to buy this stock. It's an option agreement. It's a contract agreement with you in the market to buy that stock at that strike price. And when it blows past it, you still had a right to buy it at that price. So that's what get that contract value. And you sell it back to the market for that profit instead of buying the actual balls. You just sell it back to them. You can sell it back to them for what price they have on it at that point, and that's how you make profit. Alright, the premium, this is the price you paying for the contract. So where you'll see, and I don't know, it may confuse some of y'all, where you see where it'll look like it say 50 cent and then it end up being like $5. No, what is it? It'll look like $1, but it's $100. It'll look like 50 cent, but it's $50. That's because it's giving you the price based like per share, but each contract allows you to control 100. So that's why I don't know why they won't just put it. Well, I do know why they don't just put it like, because it's not meant to be like that. It's supposed to be broken down that way. But when you see those at 0.5 or 0.55, and then when you go to buy one contract and they say it costs $55, you'll begin to understand what they're saying. They talking about per share, and each contract is giving you control of 100 shares. Consideration: the premium influenced by factors such as, this is what's influencing the price, the premium of them contracts. That's what we were just saying. It's more than just the price. The time until expiration, that time is theta. You'll see theta under, and I'm gonna go into that in the advanced course. Theta is the amount that you're losing per day. That contract that you have that contract, and it's usually not much if you got them out a few weeks or a few months. But if you got contracts expiring that week, that theta is gonna be high. So every day, if the stock don't move at all, and it goes like, if Apple was at 150, if it was at 149, and you got 150 calls expiring Friday, you bought them on Monday, on Tuesday, if it's still at 149, you gonna be down on that contract, because that's also a part of how they price the contracts. So it's not just the price of where the actual stock is, but it's also going to be the amount of time that you giving yourself. So it's a game you playing against the market. You buying time, and you kind of putting together a lot of different tools, like your fundamentals, your which is your reports. You looking at your balance sheets and all that stuff to see kind of how that company typically does. You looking at your technicals, which you talking about your charts. That's when we start seeing them double bottoms. We start seeing bullish divergence. We're understanding where that's going. You taking all of that stuff and putting it together to give your best. You're not guessing. You giving your best. I don't want to say guess. That ain't a good word to use. But you putting it all together to make your best judgment on where you see that stock price going, and then that you strike. And the market volatility also plays a big role in that. That's one thing that even Drake and myself in the beginning didn't understand that as much as we do now. That market volatility plays a major role in the price of them contracts, because you have some traders, they just trade off of the volatility, because when a certain company is coming up on their earnings, you'll see the IV go to 100%, 150%, 175%. That means that the volatility in that stock is going through the roof, and that's gonna happen every time they coming up on earnings, because you got a lot of people that just trade during that time. You know what I'm saying? They'll trade. Some people make money just off buying a option contract when the stock is down and it's about a month or two out from its earnings, and let it run. That they'll catch that earnings run, that earnings rally. And when they get right up the earnings, they'll sell, regardless of whether they think it's gonna pop or drop. They gonna sell because they about to make money off of just the volatility that went into that stock, and because a lot of volatility went into it, it raised the price of those contracts. So just to give you an idea of everything that goes into the premium and the price of them contracts, um, not just the asset price, not just the stock price. You talking about the time you buying, market volatility, and to be honest, I think it's a few other things that go into that. But these are the main things that are gonna price a contract. Chime in, Drake, if you got anything on any of those. Cause I know we both experience things in our own different ways with our different trading styles. So
Yeah, so basically, Jerome is what we call a swing trader, and I'm a day trader, right? Uh, some of those things he said don't apply to me, and some of those things he said do apply to me. Basically, like I only use once. The 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 only downfall to my style of trading, it has to be a high volatility stock. Gerard can apply his style of trading to any stock and make money off of it. But me, I only trade basically one stock or a stock that's similar to it, and it's just basically off of volume pump early in the morning. He will go over and show you that day trading is you're holding it for 1 day and you're riding that volume of that stock. And swing trading, you're holding it up to from 1 week up to a couple of months. So, and that's more of you're going off technicals on, well, you going off, it's really a multitude of everything, but he will go through that and show you the two different styles of trading.
so let's see. This what we this what I was talking about when I was referring to if Apple's uh, stock price is at 149 and you got 150 calls, you are at the money. That's here. An option contract considered at the money when the underlying asset price is equal to the strike price. A lot of times you're not gonna buy a option contract when it's directly on it, but at the money is the closest contract to the strike price. Just like here in this little picture, these are at the money calls because the strike price is currently 2.595. It ain't hit 2.6 just yet, and you got 2.5 is the closest call contract to the strike price. So at the money calls are going to be the closest strike to the actual strike price. In the money calls are going to be the ones that are already the strike price is already passed. For some reason, this one is backwards. Drake, this the one we've had this backwards since we put this course together. Webull allows you to flip the options chain, like whether you want it ascending or descending. For some reason, it's ascending as you go down. I'm used to it being the other way
Yeah.
around. But on this one, pretty much the way that it's set up, in the money calls would be here because the strike price is lower than where the actual stock price already is. Out of the money calls are gonna be the ones that's higher than the stock price. To where
That's
like,
because it's a put. This is a put. What's the one you see up there?
oh, okay, but it got calls and puts on the at the top. That's why I wouldn't understand it, like why it was going up.
I see what's going on with it. It wasn't just on puts or calls. It was on both of
It's on both. Okay, yeah. See, I
them.
use Robinhood.
Yeah.
Webull
Yeah.
That ain't even my area. I stick to Robinhood, but I do see what on Webull you can put both on the screen at the same time. So I guess this is how it show up when you put both on there, the calls and the puts.
Mm-hmm.
Let me see. What was I at? Okay, in the money. If you got in the money calls, they're gonna be more expensive because now you're not saying that the stock price is gonna go to that price. It's already past it, and the further it goes past it, the more value those options contracts are gonna gain. But they're gonna cost you out the gate because they. That's like saying I'm gonna give you the option to buy these footballs at $4 and they already $5. I'm not gonna give you a cheap contract because you already $100 in profit if you turn around and sell them today. So, you know what I'm saying? The contract gonna cost you. But if you go out of the money, the footballs is $5 right now, and you want to get a contract for $10. You you're gonna get some cheap contracts because of the likelihood of it being at that price. It's less likely for it to hit that price, even though we know we'll look at the market and see every year around like August, July, football is going to like $15. So I'm cool with a $10 strike contract on footballs out to October. Cause yeah, I'm gonna get them cheap right now, and then come like June, July, they gonna be cooking. You know what I'm saying? And then I can sell a couple contracts, or I can sell the whole position. I could peel a little bit back, and that's what I'm gonna go on in the advanced course. How you scale into positions, scale out of positions, cause you can start buying them contracts on footballs in like, let's say November. It's the end of the season, coming towards the end of the season, December. You can start buying them then. He might want to sell them to you at like $6 then, $7, because he still got some that's selling, but they ain't selling as much. Then come like January, you getting them at like $4, but you could have been buying them contracts, a couple here, a couple there, scaling into that position and lowering your overall cost basis. And then once you got into that position, the size that you want to invest in that specific position, you hold it, and then you let it turn around and come back up. And this what I'm explaining to y'all is swing trading. I'm explaining this to y'all from a swing trading perspective, because that's more so my style. I know how to day trade. I can snipe some shit every now and then. You know what I'm saying? I hit some good sniper scalp trades. But to be honest, right now this is not the market for that. So that's mainly why I stick to swings right now. But also that's not my primary style of trade. So everything I'm explaining to you is more so from a swing trading style. Anywhere from 1 to 2 weeks. I'm holding contracts anywhere from like 1 to 2 weeks and up to 2, 3, 4 months. So yeah, that's kind of what in the money, at the money, out of the money. That should be a good breakdown on how you should look at that when we say that. Cause you'll hear us say this in the group. I'm going at the money. I'm looking at the money calls on Tesla. I'm looking at out of the money calls on Tesla out for like 2 weeks, 3 weeks. So when we say this stuff, we not gonna say it with a whole disclaimer like this here that's telling you what it is. You know what I'm saying? That's why we have these courses in WAP, and that's why we do these courses live. We try to do them at least once a month, and once we get on a roll and we able to get Hunter in the loop with us, he's gonna be helping us with getting them out at least a couple times a month, and not just focusing on just these. I want it to be based on where you guys need help. I'm gonna start putting it out there and seeing where everybody kind of needs a little bit of help, and we'll structure a course or a live based on that. And we'll come here, we'll work on it together, and then we'll get back to it throughout the week. Alright. Key takeaways: your fundamental understanding of stock options and the type of options and their purposes. I think we hit that on the head. We might have been a little OD on it, but I think we hit them on the head though. Key terminology. That's what I was just saying. Understanding what all this stuff means when we say it in the group, it can get confusing, but you're gonna keep hearing it and hearing it and hearing it, and then it's gonna make sense. Especially like when I started talking about data, a lot of that ain't gonna make sense initially if you don't understand economics and stuff like that. When a lot of that stuff I didn't understand, but it play a major role in what we're doing here. I'm talking about all the way down to retail sales data. You go find a company that's looking good on the technical side, like Target right now, way oversold. Everybody want to boycott Target and not want to. I'm looking at it to see when it's fun to find support. Cause damn, what you going in the store to buy? I'm waiting on to find some support, and then when they come and do a retail sale, we coming up on a retail sales data. I'm finna go buy me some cars. And y'all argue on Facebook about what you not gonna shop, and I ain't doing all that. I'm finna go make some money in the market based on all this that's going on. You know what I'm saying, in real life. So that's kind of where we go with understanding the terminology, and I think we should get deeper into y'all understanding that terminology for like those reports, cause I put a lot of that stuff out there, and if anybody don't understand something that I put out there, let me know so that I can understand that that's something we need to get y'all freshened up on. Though, you know, we need to address that. Risk and reward dynamics. This is the most important thing, man. If you understand proper risk management, you can't really lose in this game. Cause you gonna take losses, but you're not gonna lose. Damn, that was good. You gonna take losses, bro, but you ain't gonna lose.
That's real talk. And like, so Rob was talking on the phone today, and Tesla had some good news come out. I thought it was going to be a buy the rumor, sell the news.
Mm-hmm.
And today, I lost $1,000. But I knew at that point, like, I can, where my account is right now, like, I can lose $1,000. It didn't bother me. And Gerard kept talking like, you know
Mm-hmm.
what I mean? Like nothing even happened because I know, okay, I just cut ties and I lost 1,000, and tomorrow I'm gonna make it right back. You know what I mean?
Mm-hmm.
But you know what I mean? We've had some days
Man.
where we weren't doing the proper risk management, or we stayed in something too long. I remember, you know what I mean? I think we had some $10,000 days that we lost. You know what I mean? I had a $7,000 day where I lost because of this right here, uh, having too many contracts, and it went the wrong way and it hurt my account.
Mm-hmm.
You know what I mean? So never trade, never over trade. You know what I mean? Just because you got $10,000 in your account, only play with two. You know what I mean? You know what I mean? Leverage that $2,000 to where you making 500 with, instead of filling that account up, so you can buy more and more contracts. Once you get $20,000 account, play with 5,000 a day. You know what I mean? And just keep building and building that account up. Just because you got 20,000 account, don't go play with 15.
Mm-hmm.
But if you lose 15, now you only got 5 racks.
Yep. There's a there's a system I kind of use, and instead of it being in my head, I think I should kind of break that down in one of these courses to y'all, where I kind of use 10%. I use no more than 10% in one position, and I usually don't even go that heavy, but no more than 10% in one position, and I don't lose any more than 50% of that whole position. So a total, if it's a 10% position of my whole account and I lose 50% of that, that's 5% max I will be losing from my account. On top of that, another layer of risk management is averaging into those positions. If I want to go, let's say I want to put, I got 30,000 in this account. I want to put 3,000 into this position. I'm going to average into that position in thirds, and let's say I find my first entry, I'm gonna put $1,000 into that position worth of contract, and it may go into it may dip a little bit more. Okay, I'm gonna hit them again here with another $1,000. My max that I want to put into that position is 3,000. It may not go all. It may not get to where I'm ready to drop another grand, and it may pop. That next day, it may pop. I'm not gonna chase it and make sure I get 3 grand in there. I'm gonna allow it to run and do what it do. And you know what I'm saying? Money, green is green. Yeah, you didn't make as much as you would have made if you had 3 grand in there, but you damn sure ain't lose. And so, also, when you go to averaging the positions, that's allowing you to gain a better position versus dumping all 3 grand in there, and then I gotta watch it go red, damn near hit where I want to cut my losses, and then it turn around and pop that next day when I could have averaged into that position gradually and I got a better position. I wasn't close to my stop loss where I want to cut my losses, and then turn around the next day and you up. So that's another layer of protection. But using those two strategies, like taking a small percentage of your account that you want to put into each position, whether that be 5, 7, 10%, and then only allowing yourself to lose a maximum. Like my mentor, he only allows himself to lose 40% of any position. Me, I allow myself to lose 50% of any position because I go smaller on my position. So I don't mind losing half of that. Because I know if when I entered, I put it in at a really good position. If it keeps going down, there's something else going on. You know what I'm saying? Then if it keeps going down, there's probably something else going on. And by the time I get to that third entry, if it's down far enough, I can kind of see what's going on. And if I'm expecting it to turn around, I'll go ahead and put that last 3 in there. And then at that point, you got to watch it and stay true to your rules. If you get down 50%, cut the loss. You're not going to want to. But it'll be 10 times worse if you see it go down 75 and 80% versus cutting that loss at 50, finding out what you did wrong, learning from that, and then going to find you another position to make some money. Let's see. Import of key terminology. We're going into turns. Yeah, we're going into turns. I think we're going to flow through these because we done talked about some of these. Calls. We talked about calls. Stock going up. Puts. We talked about puts. Strike price. Expiration premium. In the money, out of money, out of money. Okay. Target practice calls and puts. What are they? How they work? And when to use them. Yeah, let's go into this a little bit. We're going to explore the options in depth now. When to use calls. Again, the calls is when you're expecting the market to go up. You're expecting not the market. You're expecting that particular stock to go up. So in a sense, in a bullish market sentiment, that's when you're anticipating the market going up, upward movement, upward momentum. That's why when I say we looking, like earlier the message I put out in the group, we got some data coming out later this week on inflation. If that data is good and the market has a good reaction to that, we could begin finding some support and rounding back up to the upside, pushing back up to the upside. Bullish market sentiment, anticipating an upward movement in the underlying asset. And that's why we want to be in position, because if you in position, you don't miss the wave. If you wait to get in position, you're going to miss the wave and you might catch a drawback, like a retest after trying to chase it, you'll catch a drawback or a retest to where you get in at the wrong time, and now the market coming back down, but it's really just coming back to retest and then continue in the direction it's going. Leverage, control a larger position with less capital. We talked about that a little bit. Time frame, you're gonna consider the expiration and the market conditions. Now that's why this time frame when and considering the expiration date and market conditions, that's what I mean by right now I'm playing swings because the market conditions aren't suitable for my style of trading those short swings like that 1 to 2 weeks. That is not it's dangerous playing that right now because Trump will wake up and tweet something in the morning and sink the damn market before it can even open. Like just random tariffs. I'm gonna turn Canada to the 51st state. Like just say any damn thing he say like that. It can trigger things. So like this ain't the time to be doing too many. You can't have as much confidence as you would want in some of those shorter swings like I usually play. So right now I gotta get these deep swings, and when I do play anything shorter, it's usually like a scout like Drake. Like you can kind of get the feeling of what's going on within that day, and catch that wave, catch the momentum, catch the volatility. You can catch that. That's what Drake is doing right now. And Drake will tell you like it's like we go back and forth with the sentiment of the market. When it shifts, you'll start seeing my style of trading being more favored versus a day trade. Cause while I'm averaging into a position that is coming down, a day trader that was expecting the market up might be losing money. But I'm better in my position, so when they do turn around and swing up, I'm good. But that's not good for a day trader because it's slowly killing them. So market condition and expiration date, that's something major to take into consideration when you trading these options. Examples of buying call scenario: you buy a call option on XYZ with a strike of 50, expiring in 1 month for a premium of $2. If the stock rises to $60, you can exercise your option, buying them at $50 and realizing the profit. That's just what we were saying earlier about exercising that contract, which most of the time that's not what you're doing when you're trading options, but you do have that option. That's why it's called an option contract. Scenario 2, which is the more popular scenario for options traders, if the stock stays below and expires that's not the most popular, my bad. If the stock stays below $50, the option expires worthless and your loss is limited to the premium of $2 per share. Now, I don't encourage just letting the contract expire because you should know. You should have a pretty good idea when a stock is moving and what's going on in the market, unless you're just not paying attention. You just letting the money just sit and expire. Cause you can recoup some value in that contract, even if you got a losing contract. A lot of times you can get $10 out of it. You can get. I'm selling mine. I need something back. You know what I'm saying? But essentially, if you let it expire, then it'll expire worthless, and you just don't get nothing back. There should have been a third scenario on this, which is the stock goes up to 60 and you sell the contract for a profit. So we need to change that. That's a little misleading. Potential outcomes for calls. In the money, the stock price is above the strike price, providing intrinsic value. We talked about that. At the money, the stock price equals the strike price. The option may retain value, kind of like if it stays where it is, and you got some time, you won't lose much value. You'll lose maybe a little bit of time value, but for the most part, it'll be pretty close to what you got it for initially. The out of the money stocks, the out of the money contracts, The stock price is below the strike price, leading to potential expiration without value. That's what's happening as that's what we mean by losing time value. As time go on, you got less and less time for that stock to make it to that strike price that you said it was going to. And puts is the opposite. Everything we just talked about in calls is the exact opposite. The difference with puts versus calls, the market goes down way faster than it goes up. Um, you gotta think when people are buying stocks as the price is rising, you have a lot less. I should say you have a lot more people that are gonna sell stocks when it's going down versus people that's gonna buy stocks as they going up. Because typically you should buy stocks when they come down, buy low, sell high. For stocks that's going down and you selling them, you just trying to sell them to recoup whatever profit or cut whatever loss you can. So it ain't no such thing as just sell high and then nah. When the stock going down, it's going down fast because everybody's selling they shares. You got stop losses being hit. You got people exiting contracts. All of that is happening at the same time. So a stock will go down way faster than it'll go up. When to use puts in a bearish market, same thing. Well, same thing as bullets, just the opposite. You got a bearish sentiment in the market anticipating a downward movement in the underlying asset. Also, you buy puts, like we said in the beginning, for hedging, protecting those existing loan positions to provide insurance against price declines. So that's you got something on that, Drake?
My bad. My service had one. I'm just gonna didn't.
No, it's all good.
What you
It's all good. I thought you
what you
shared
had said?
something. I was just so puts. That's what we spoke on earlier about hedging, using those to hedge your portfolio or hedge a position. If you got a sizable position with a decent amount of time in it, and we expecting some turbulence in the market, you can grab you some puts on that same asset, that same stock, whether you got a sizable position in shares or you got a sizable position in options. Let's say I got options out to October in Apple, but I see we finna have some turbulence in the market and I'm expecting us to get a nice drawdown. I can buy some June puts as the market's coming down, maybe sell them in April, and even if it comes down a little bit more, I hedge that portfolio. I recoup some profit from the market coming down without just losing profit while it's coming down in those calls. So that's what you're doing when you buy puts to hedge your portfolio or hedge a position.
Basically, yeah. And it's always the reverse too, because you got some people like me and Gerard, we are bulls. You got some people that are bears, and they
Mm-hmm.
will head their puts with calls. So it can work either way, because some of y'all might not be bulls like we are. Y'all might like to play the puts because sometimes stocks fall faster than they go up, and you can also
We got a couple questions
uh,
in the
okay,
Discord, but go ahead. I'm gonna hit them. I'm gonna answer them when you're done.
and you can also hedge earnings calls. You got some people you don't know which way it's gonna go. Some people buy calls on one side and puts on the other side. So
Mm-hmm.
whichever way the stock go, they make money that way as well.
That's a straddle. That's a
Yep,
straddle.
yep, yep.
That's one of the strategies that we'll be rolling out in the more experienced options course. But to be honest, I don't even do that too often because I like to pick a side, man. I don't like to play both sides. I tried earlier on when I was learning, and it just used to frustrate me because sometimes it won't move enough to one side or the
Yeah.
other, and you still a lose. Like that shit used to really piss me off. I'm thinking
Yeah.
I'm covering it on both ends, and it don't move enough either way, and you just lose altogether. You know what I'm saying? So it take experience, and it take you being able to understand how much a stock is liable to move, and really understand the volatility, and you got to understand the market when you plan those type of strategies. But we had do you prefer new day trader or someone new to day trade or swing trade? Starting out.
I can comment on that right quick.
Go ahead, bro.
All right, so basically, whether you want to become a day trader or a swing trader is basically on your style. I mean, on your availability.
Yeah.
If you can't be looking at your phone like that, or looking at your computer like that throughout the day, you don't want to day trade because it's gonna take your money. You know what I mean? If you got a job where you can't look at your phone or you got something going on throughout the day, more than likely you want to lean towards Gerard. You know what I mean? And the plays that he put in, because like he told you, he made anywhere from 2 weeks to 3, 4 months. You got time to make the money. You know what I mean? You don't have to keep looking at your phone. You don't have to, you know what I mean, miss out on stuff because in a couple minutes the stock market could be gone in a day. You know
Mm-hmm.
what I mean? And but if you got free time and you want to make, quicker moves in the market, maybe you could day trade. But day trading takes you gotta have ice in your veins sometimes,
Yeah,
especially if you own some of these bigger stocks like Tesla and stuff like that.
for sure. Yeah, that's exactly how I would have put that. That you would base that on your availability. Like he was saying, if you're not able to watch that screen, you don't want to day trade because you can't assume that the market is going. It only takes for somebody to say one thing or one thing to happen and it go left. Soon as you just cut your phone off, or soon as you went back to work doing something, and you come out of your phone and your contracts is down 99%. You know what I'm saying? Like it'll happen that fast. So day trading, you want to be able to watch the screen, and not all the time. Like sometimes you can day trade. You don't have to go to all the way to completely to one side or the other. You can base what you how you trade on your availability at that current time. Like if you got some time, you off from work for a little bit, school, whatever it is you do, and you want to learn some day trading, you want to get some day trading in, you set you a time frame that you're gonna be focusing on the market and understanding what's going on and executing you a few trades. And then you see how you did, you reevaluate your performance throughout that day, see what you did wrong, see what you did right, and better your skills. Then you can take, like I said earlier in the group, you can take some of that bread from your day trading and roll those into the longer
Mhm.
positions. You can turn you make $100, $200 in the market. You can go and get another contract that's out a month or 2 months. You know what I'm saying? Out of the money contract that's like $100, $200, all off a profit that you made in day trading. So once you understand how it works, you can really do both, but it's based on pretty much your schedule and your availability. Um,
Yeah, and one more thing to say about that too. We have a student named Hunter.
yeah,
Uh,
I wish Hunter
he,
was in here, man.
Gerard, huh?
I wish Hunter was in here. He been with us from the get go, and he doing his thing now.
Yeah, Gerard and I taught him, and he got on. They learned both of our styles
Mhm.
fluently.
Mhm.
So he might be day trading today, and tomorrow he hopping in swing.
Mhm.
He might sell those swings, and the market changing up, and he made day trade 3, 4 days in a row, and then boom, he jumping right back in the swing. You know what I'm saying?
Yeah.
So it's good. You getting the best of both worlds. In some cases, you got people that can only swing trade, and then you got some people that can only day trade. You know what I mean? So you really getting the best of the both worlds, and that's the Just because I'm day trading, I might make 600 today. I might make 500 tomorrow, 400 the next day. You think the money's better over here day trading? It's coming quick. It might take me a couple days to make $3,000, but when those swing trades start hitting, and in 2 weeks Gerard done made $6,000, and he ain't have to look at his phone and risk losing that every day.
Mm-hmm.
It's a different type of money, and it's
Mm-hmm.
all the same. If you get what I'm saying.
Mm-hmm. Another thing to take in consideration when you picking and choosing which way you're gonna go is your tolerance for your stress tolerance, man. Day trading is gonna have you on edge because the market fluctuates up and down. It don't just go in one direction. You'll see Drake put in a position on Tesla and that shit go down. He'll put in a call, that shit go down. And it'll go down. He may be over there holding or averaging in one of the two. And then next thing you know it pop. That's day trading for you. Now swing trading, you got more time, so even if the stock is going down, you're not gonna feel it as much in your pocket. Like it's not gonna lose as much value because you got a lot of time in it. And then, as time go on, it's allowing you to either average in, sell for a profit, whatever you need to do. You can better control the wheel, when you got more time. So I think that pretty much your idea on that. As far as the next one, strike price, your strike price is a fixed price. That's the agreement that you have pretty much stamped on that contract that you are expecting that stock to either go to and above on calls or go to and below on puts. So yeah, it is a fixed price. But you pick your strike price on the options chain. When you buying the options contracts, you pick what strike price you want. But once you buy that, that's what it is, unless you sell and go to another strike, or you can roll your position where it does pretty much the same thing. It'll sell that position and roll it to another strike price. If you want to roll up, you got 150 Apple calls and you want to roll up to 160 calls because you see the price going further faster. It's gonna sell that position at whatever you at, whether you at a profit or a loss, and then it's gonna buy the other one at whatever price it's at. Same amount of contracts if you roll a position. Swing trade. This is the last. You don't necessarily make more money either way. Honestly, it depends on you and how you manage your positions in your portfolio, whether you making money or losing money, regardless. I don't know what you're doing. You can be the best swing trader in the world if you're not managing it correctly. You can be losing just as much as you making, or more. So, swing trading, don't look at it as a how long does it take. Look at it as what's more comfortable for you based on your availability and your tolerance, like your style of investing, because it ain't a slot machine, bro, like where you just put it in and okay, I'm in a swing trade, so I know I'm gonna make this in this amount of time. Now you look at it like, I would rather average into these positions over time, sit back, watch the market, see what's going on. If my contracts do go down in value, I ain't gotta worry about them going down too fast. I can sit back and evaluate what's going on. I can average in, or I can sell for a loss. As the market's going up, I don't have to hurry up and sell before it go back down. I can sit back, watch the market, evaluate everything that's going on, either sell for a profit or hold it a little bit longer because I got time. So that's how you should look at that. As far as swings versus your day trading, um, swings definitely safer for that reason.
Yeah,
Yeah, swings
I'm
definitely
gonna tell you,
safer though.
I'm gonna be honest with you. I didn't got my head pulled back, and I mean, I'm talking about an hour. I'm talking about thousands gone. You know what I mean? Sometimes I wish I was swing trading when
Mm-hmm.
you take a loss, but it's about looking at that percentage of your win rate. And you can ask Gerard, I went through a hard time day trading. I went through a phone. And I looked at Gerard and I told him, I said, man, I'm gonna start focusing on my win rate. And ever since then, it's been like beautiful.
Yeah, for sure.
But until you can get to a point like that, I always throw you some swings in there, man. You gotta swing trade until you become a sharpshooter.
Mm-hmm. That's where the bulk of your because the market takes time to move. So if you're making money day trading, it's because you're taking risks. It's because you taking risks. And you're not making money day trading if you're not taking no risk.
Yeah.
Like if you're trying to be safe and day trading, you trying to be too damn safe day trading, you ain't gonna really make no money because that's a risky game. Um, Swing trading is the safer option, but it's slow. It's slow stroke. Like you ain't really you gonna see some swings though that will pop just off of
Yeah.
maybe some news or some earnings or some. But for the most part, if you really looking for them contracts to pop, that's your day trading. But it's more risk that come with it. Oh, let's see.
And this is what we teach you how to paper trade first. This is what we teach you how to paper trade first.
Yeah, for sure. Then you can actually see how they move, how the contracts are gonna gain or lose value based on the stock moving. That's what's really good about paper trading because not just looking at the dollar amount that you made or lost, but looking at how the contract or how that position reacted to the market or to that stock based on what it actually did. And you can start understanding better, okay, when the stock does this and I got contracts out this far, this close to the money, this is how it affects it. You know what I'm saying? Without the feeling of I made or lost money because it ain't your money. You know what I'm saying? You can actually see what's going on in real time and you can focus on that. So then when it does happen, cause I'm telling when it does start happening, when you start making or losing money off of each individual position, there's gonna be feelings that come with that initially. We've grown to the point now that we understand the market is gonna do what it does. So whatever happens is based on it's the exact result of what we did. You know what I'm saying? It's not no damn this market shit ain't what it is or man I'm killing this market shit. Nah, you just putting yourself in position based on the knowledge that you have and then you allowing the market to do what it does. That's all you really doing. Um how long is how do you decide and what makes you feel secure? Um
What was the question? Read the question again, Gerard, because
it said
I ain't got some.
how do you decide I'm gonna keep going through this too while we answering questions so we can go ahead and get off here. Um how do you decide what stock to buy if you swing trade and what makes you feel secure about that stock? So to be honest, I don't go reaching just for random stocks. I more so let them find me because if I'm looking at a stock, it's based on some parameters that I have set that says this stock is worth looking deeper into. That's why every now and then you'll see me say in the group, "Oh, there's some X, Y, and Z is happening, and we may get some momentum or some money going into the energy sector, or into the retail sector, or into the industrials." Um, and then once you zero in on like a specific area or industry, you start sifting through companies that are good companies in that space. And once you find the good companies in that space, you can start looking at their technicals and see how they've been doing lately on the charts, how it's looking. And once you start breaking it down like that, you will begin to see that things align. Like for instance, let's say Um, as we going into all this bullshit that's going on with tariffs and the wars and all, as it was coming up, if you went and looked at Lockheed Martin or what's the other one, the other defense stock, the main one, RTX,
Yeah.
RTX, or if you go
Palantir.
Palantir, or you go look at the energy stocks because they rally when we start going into wars and having that economic conflict, like ExxonMobil, they cooking right now. If you understand what's going on the fundamental side of things in the economy, you can go and look and see where the money may be going or find those opportunities. You know what I'm saying? And that's just me. That's how I find it. That's how I sift through things. And then I also look at the ETFs, which is the trading funds that hold different companies in different sectors. Like you got the retail ETF, you got the energy ETF, you got the Jets is the airlines ETF. Um, you can do stuff like that, and just like for instance, Jets. When all this stuff first started popping off with the planes, all those airline stocks weren't down. Some of them were still up, and you can find some of them that on the technicals they peaking, like they at the top. They ready to come down anyway, and it's starting to get into that environment where it's gonna allow them to go ahead and come on down. And that's when you go and find if you a bear or you want to play some puts or you trying to look for things to play to the downside while the market is looking bearish, you go and look in that area and you'll find some stocks that you can go into and go and grab some puts on. Swings. That's a good way to play them swings. If you would have played swings puts out to June on United Airlines at the beginning of February when that shit first started pop, I guarantee you them puts is up. April, May, June puts on United. I guarantee, I'm 100% sure they up right now. For one, the whole
Yeah.
market is came down, but the airline sector, we still every week seeing this at the head of the airline, at the head of the news. They keep showing us all these plans, and that shit ain't by coincidence, man. They do it on purpose, like they move the market how they want to intentionally. So that's how you find those. That's how I find them anyway.
Yeah. And I mean the news will dictate what a lot of stuff gonna happen. I mean, just simply listening to the news, like I was telling you how Marquis is very in tune with the news. It would dictate what stocks you need to be looking at. Um, for instance, like Gerard was just talking about the airplane situation. I remember when all that happened with what's that stock?
With Boeing,
Uh, the airplane stock. What they
which one? Boeing?
yeah, Boeing. All right, Gerard seen some news on when Boeing had all the planes falling apart in the air.
Oh, that was last year.
Gerard came back and told the group,
Yeah,
and we made a move on it.
yeah.
That day, everybody in the group played puts on Boeing. We got out quick. I think I made about $700. A couple more people made about $500-600. I mean, it was maybe about 8 or 9 people that followed Gerard's play. I ain't even day trade that day on nothing else. Just followed Gerard's play, and I think I had like 3 puts. Everybody else had 2, 3. You know what I mean? We making right under $1,000. Gerard went crazy. He bought like 12, 13,
Yeah.
18 of them motherfuckers and hit for $10,000 in one day.
That was
You
my
know what I mean?
first big trade. That changed me as a trader. I ain't even gonna count because I wasn't nowhere near as experienced as I am now. I just know I had seen certain things happen in the market And if you're gonna step out on faith and risk, that's the time to do it. When something is actually going on that you see happening and you know what's supposed to happen when this stuff happened, and the stock wasn't even going down like that until after the market closed. It tanked, and that morning in school, I'm waiting on the market to open, but I'm already knowing like I'm finna be up because of how down the stock was. And when the market opened, yeah, 10, just over 10 bands, and that changed me. After that, I couldn't unsee that. Yeah, that shit was different.
Yeah. Swing trades are good. Like me and Gerard, we ran across one guy before Tesla went up crazy. He bought like 20 Tesla calls, maybe about he was probably about $60 out of the money. So that was real cheap.
Mm-hmm.
Cost him about $4,000.
Mm-hmm.
Anyway, Tesla did what he said and went past his strike maybe about $80.
Mm-hmm.
And he turned $4,000 into $208,000 in less than 3 weeks. So it's different ways you can manipulate the market and make money off of the market. And you can put it's a thousand different styles you can do. Just long as you making green money with it, you good.
I ain't gonna hold you though. I wouldn't have made it to 200K.
Hell
I
no.
I sold them bitches at about 20. I'd have been out of there. I'd have been out of there. I ain't but that's because I haven't sat in a position that long to let it do that much, bro. Like it's
Yeah.
hard to look at that much money and just keep over. You waiting through weekends, anything can happen, bro. Like
Yeah.
to sit there and allow that position to mature like that, you gotta have like nuts of steel, cause anything could have happened. You know what I'm
Yeah.
saying? And you could have went from being up 100 to up 50K and be kicking yourself in the ass by losing 50K by not taking. You know what I'm saying? So it take a
Yeah.
lot. It take a lot. It's gonna take you on a mental trip playing this game, but it's rewarding though.
Yeah. And yeah.
I think we went over that pretty much. Potential outcome for puts, understanding the market. That's kind of what we've been talking about. Market movements, fluctuations, um, economic indicators, earnings reports, and geopolitical events. That's kind of what we've been going over. Now that's what we're talking about. How the market fluctuates. That was good questions too, though. I like that. I like that because it makes me think about the shit we actually doing and and elaborate on it. Um,
Yeah.
bullish market, rising star. We understand what the bullish market is, a bearish market, volatility. We,
Hold on. Before we go past that, I know people be getting stuck on that. Do everybody know what a bullish market and a bearish market is? If you don't, let us know now.
well, we just talked about it on the other slide. It should.
I just want to make sure because we'll get deep and people don't know what bulls and bears is. So I just want to make sure that everybody grasps the concept.
Oh yeah, for sure.
All right.
Let's see. Analyze is key. This is also part of what one of the questions about how you find good stocks for swings. Also, when you get into a position, especially swings, that's when the work really starts because you only do so much work before you get into the position. Because what happens next is more important than what already happened. So that's when you really got to do your homework on them stocks after you get into the position. You got to be seeing what they doing, how things going, how shit moving, what their plans are, whether they still going in the same direction they said they were going with things when you last checked before you got into that position. Are they about to acquire a company? Because if they start talking about they finna acquire a company, I'm gonna tell you now, 9 times out of 10, that stock is gonna come down because that's them buying another asset, them taking money out of their pocket and buying another asset that isn't guaranteed to make them money. So the market doesn't really reward companies that acquire other companies because usually when they're acquiring them, those companies haven't like just went crazy making money yet. So it's a little bit of risk and liability there. Um, but shit like that is the stuff that you look into when you get into a position. That's when you really dig into them companies and you find out everything you can about them because that's gonna give you that confidence to stay in that swing and know why you in it. Swing trades, you need to know why you in them, how long you plan on being in them, and what reason you would get out of them. And you only gonna know that is if you keep up with what's actually going on with that stock in that company. In this lesson, and I say that shit, man. But to be honest, I'm gonna be real with y'all. Some of this shit, I go against my own rules because I see a lot of these companies do certain things. I'll go against my own rules and still stay in the company even though they not doing what they said they was doing because I've seen the market do different things and it'll bite me. Sometimes it'll bite me. Sometimes I'll make out pretty good. But you should continue studying these companies and understanding what they're doing, where they going with things, and when shit changes, your position need to change. If they go to shifting and changing what they had going on, you need to change. Alright, let's see. Why analyze understanding their fundamentals, their banks, their statements, their earnings reports is the main place you gonna get. This the main place you're gonna get the outlook on where a company is going with things, and this is where you're gonna get majority of the volatility. This is the way that last month when I hit the Netflix that was on earnings, they was looking good on the fundamentals. They looking good on the technicals. They were oversold on the technicals. Fundamentals was going crazy. They doing live events. They doing, um, I think they put games on Netflix, and they subscriber numbers, subscription numbers was going crazy. Like everybody like got Netflix nowadays. So for their stock to be going down the way that it was when me and Drake was eyeing that, it was coming up on earnings, and we've seen it too many times. We've seen it too many times where Netflix will go crazy on earnings, and we just I ended up sticking with that position, and that one ended up paying out like $7K. Um, yeah, company news helps gauge the stock's potential performance. Yep, that's what we were just saying. Technical analysis utilizing the charts and indicators to provide an insight into the price trends and potential entry and exit points. That's a good point, though. The technicals, you should really lean on technicals for when you're gonna enter and exit a position, or why you would enter and exit a position. But more so when, like your entry and exit position, is your entry and exit points for a position should be heavily based on technicals if you understand them pretty well, and then your why comes more so from the fundamental side. It can be technical, but you want to also have a why on the fundamental side, because just because they oversold don't mean you enter it, because they might be oversold for a damn good reason. They finna keep being oversold. So, you got to understand it on a little bit of both sides. During holidays, do you look at certain stocks more than normal? Yeah, that's fact. You do. We have a Santa Claus rally every December. Now you can't know exactly when it's gonna be, and sometimes you'll be in it and be thinking we finna get a Santa Claus rally and it's already rallying. But if you in position, you ain't gotta worry about getting in position or missing the wave. So And to answer your question though, yeah, you do focus on some stocks, particular stocks. Um, just give me a. Let's do this. I'm gonna keep going with this. Give me about 2 or 3 companies that you would think during the holidays that you would expect to go up or make money. I'm gonna see where your head at. Impact on option strategies. Selecting the right options inform. I'm gonna be checking to see what y'all say. I'm gonna keep going with this though. Selecting the right options inform analysis helps traders choose suitable strike prices and expiration dates. Yeah, that what we were saying earlier about understanding where you see the stock going within a certain period of time. That's where you choose your strike. So to answer that question from earlier, this is kind of this going back over that, like understanding which direction the stock going, what type of momentum it got, and what's actually going on in real life. Um, Walmart for sure. To be honest, Walmart is like a safe haven for big investors, like major investors, major corporations. Walmart constantly goes on like a slight incline, like all the time. They just had a major pullback last month when they gave lower guidance after their earnings. They dropped from like the 90s. They dropped from the 90s down to like the 80s. And this is honestly a good time to be getting back into Walmart because they about to start turning around. But yeah, holidays for sure. Walmart. Um, and to piggyback off of Walmart, you look at other companies in that space like Amazon, Target, and you find those because to be honest, Walmart moves slow. It goes up in like slow. So when you look at Walmart, you go look at the other retail companies because you saying Walmart because it's retail. So go look at all of that. Look at that entire sector, and find you some opportunities in the Sony, Microsoft. Yeah, but not necessarily for holidays because Sony and Microsoft they more so based on like the things that they actually have going on with tech. So they not heavy. They don't make majority of their money in the stores selling PlayStations and computers. They make majority of their money selling their software and technology to these major corporations and the government. Um, so yeah, you can say Sony and Microsoft, but I wouldn't specifically look at them during the holidays because they gonna make money in the middle of the year, at the beginning of the year, and it's probably gonna be more money made in those other quarters than they make just in holidays. Um, Same thing with Apple. Apple, Apple is they changing. They changing because they're about to go into this AI space. So they not like the old Apple where it used to move slow. I think they're gonna start gaining some momentum and not really holidays, no, but over time, Apple is gonna always be a good company to go into, whether it's holidays or not. You'll be better off looking at the technicals on Apple and then pairing it with something in the fundamental side. Not really holidays though. Amazon, yeah, yeah. Well, Amazon, yeah, Amazon holidays. Amazon is gonna kill it, especially if you catch them like going into December and they mess around and have a little drawdown pullback in November or something. If you start seeing Apple pull back anytime after October, you need to be buying it up because they gonna go crazy. I would say I should pull up a chart and go back and look at what they did. I'm like 100% sure Apple rallied anywhere between November and January. Apple did its thing. I mean, not Apple, Amazon. Um, eBay losing. They steam. They losing because they failing to innovate. Like eBay is the old way to buy stuff online. Um, I'm surprised they still around and making as much noise as they are and as relevant as they are. But I wouldn't invest in eBay. I'm gonna just be real because it's too many better companies in that space. There's too many companies in that space that are better. So I would go Amazon all day over eBay. But in the holidays, you also gotta look at what like financial companies. You gotta think Klarna. Like you gotta think along those lines. People are gonna spend money during the holidays. People gonna even spend money they don't have. So now you gotta think American Express, Visa, Klarna. You gotta think financials because they also gonna be a major player during that time because all of this stuff you talking about people buying, they have to use those financial institutions to purchase a lot of that stuff. So that's another way for you to look at it when you going into seasons like that. If you find the opportunity on the technicals and your financials, that's another good space to be in going into that season. Let's see where we at. What did we learn about? We learned about market movement, analyzing the underlying stocks, and combining your market awareness with the stock analysis enhances your overall trading success. Technical analysis and indicators. I want to say after this, it was the live and the Q&A. So this should be our last hard section to really go through. Um, we spoke a lot on. We didn't speak as much on technicals. Um, I want to do a course directly focused on technicals, but just I'm gonna go through this just to give y'all an idea of some of the things that we look at and why we look at them and how we use them. But with technicals, you want to understand why you're using certain technicals, how to use them, and this is the bread and butter of entry and exit. Honestly, you can know everything you need to know about a company fundamentally, but if they overbought, I don't give a damn how good they doing in real life. That stock coming down at some point because you got too many traders that trade off just technicals, and then just being real, like if their stock gets overbought, they're overvalued now on the technicals and in real life. Their stock is now worth more than what the company is actually worth. So it has to come down. And then how do you find out when it's coming down? That's based on your technicals. So when you got patterns like your head and shoulders, that's indicating a reversal from bullish to bearish. That's I'm gonna actually pull something up on this other screen so that I can show you at the same time. Let's do this. So yeah, I talk about it, pull up at the same time. Head and shoulders, you going from a bearish to a bullish. Right here. Let's see. That's when you get this shoulder, and then you peak, and then you get you another shoulder, and you going from a bullish trend to reversal, a bearish trend. And typically, this is where you catch your entry here, and then we fall. Now, I can go to the Telegram and pull up some of those where we talked about these. Well, we on here kind of late, so I ain't gonna go too deep into that. Damn, I should have kept that up. If anybody wanna, go a little bit deeper into technicals, me, Drake, Sam Hunter, NLS4 can kind of give you a little bit more insight on those. But just to briefly go over these, the technicals, the double bottoms, double tops, and double bottoms are signaling reversals. That's when you get in those retests. If you got a double top, that's going from bullish to bearish. You're expecting the market to do a reversal after that second top. That's right here. You got two peaks and then you going from this bullish trend bounce, and then you come in bearish, and this is the neckline. This is typically where you break and get a retest, and then you enter here. You can enter at the top here, expecting a drop, but I would usually exit here, and then if it does come down and retest, I'll re-enter because sometimes you get a range and it'll just keep bouncing. So there's different ways to play these. Um, Also, aside from understanding the technical side of it, understanding the fundamentals, why that company is about to reverse. If you got a why it's about to reverse, then these make a lot more sense. And you can kind of pair it up with events that are going on, whether it's an earnings report or retail sales or an inflation report that's coming out or something like that. So, um, what's the best time to day trade? The best time to day trade, I'm gonna let Drake answer that from his perspective, but just to give me a little bit of insight on my perspective on when to day trade, I would recommend you day trade after 9 Central, which is 10 Eastern, um, because you usually get a move right then, and you've gotten enough understanding of like the market sentiment that morning. They'll put out a few little headlines on why the market's moving the way it's moving. So you get a feel for the market within that first 30 minutes. You can start looking at some charts and seeing some of those shorter term indicators, what they're looking like, whether you getting above the anchored VWAP or whether you below it and retesting it, or all that stuff. So that's my recommendation. I would say after that time frame, and then also later on in the day, that last like 1 to 2 hours, that power hour, you can get a little rallied in and catch some momentum there too. But Drake, if you want to elaborate on that, that's more your space.
Yeah, if you watching me in the group, don't try to do what I do yet. You're gonna watch first. Cause you come over here playing, like, you're gonna lose your money. Um, I advise everybody to sit back and watch. You're not gonna see it come fast, but as quick as you um make it, you can lose it. And I trade right at the bell. You'll see a whole bunch of volume trading happen, and we do have indicators that let us know which way the market is going to be going. Like on Friday and today, I was showing Marquis. We was on the phone while the market was jumping. You know what I'm saying? And Marquis, he's just getting in the group of it. He's catching on real fast. And but he'll tell you too, it's not easy to do this. Um, Jarvis has been in the group a month, and he made his first trade today, first great trade today, right at the bell. I think he was in his play for like maybe 30 minutes or so, and he made 500. You know what I mean? So if you want a day trade, like at the bell day trade, sit back and watch a little bit before you just try to throw some money in it. And like just like Gerard said, after 9, 10:30, and then the afternoon is the best time to day trade for beginners.
For sure. So your flag and pennant patterns, those are more so your continuations. We see these a lot, but to be honest, another thing you'll notice when we in a certain sentiment in the market, you see certain patterns across different stocks because the overall market is moving in a certain way, and then
Hmm.
it just takes for that stock to start having its turn. So sometimes we'll be in the season of flags, bull flags, like everything. I can't wait till we get back to that point, man. I'm gonna be real with y'all. I'm getting my ass kicked right now, but it's a part of it, man. Like I ain't complaining when I'm hitting the air for 5, 6, 7, 10 grand. You know what I'm saying? I'm not complaining then. So my mentor was down $1.4 million. Like I can't complain about being down a couple grand, bro. This is part of the game. But you gonna get to that point. We gonna get to that point where this start happening again on the regular, and we see, oh, bull flag. Oh, we got a pennant. Oh, we got a double, inverted head and shoulders. We be killing them. These here, we kill these.
And everybody see that because you're not letting me see it, you know.
Oh, it ain't.
No, I can't see nothing.
Damn.
That's why I thought it was me, man.
Hold on. I think it's putting it on that window instead of that screen. Let me go to the Telegram. I mean, Discord. I'm gonna put it on that screen instead of that. There we go. All right, you can see it now, right?
Yeah.
Yeah.
Yep.
The inverted head and shoulder. Now I'll go back over the other ones too. I'll bring them up real quick too. But yeah, these we kill these. The inverted head and shoulders. I want to. Let me see. I got Telegram on here. I'm pretty sure I got Telegram on here too. That's what I do. I start bringing up the ones directly from the group when we play these. Alright, this the Telegram now. Y'all should be able to see. Y'all can see that on the screen.
Yep.
Alright, here we go. This when Drake was inverted head and shoulders on Tesla could see. Let me see if we got a picture on though. This is when that hunter was calling out. It was getting ready to form an inverted head and shoulders on Exxon Mobil. He got in. Did he get in those? I don't know if he got in those. I want to see the Walmart one. I mean the McDonald's one that we just called not too long ago. Here's a one on Disney. I think we killed this one. Hold on, the Disney one. It was up 62. I think we killed this one. It was up 170 here. That's FedEx. Man, who put? Bruh, y'all wow. I think that was your ass, Drake.
No, that wasn't me.
Y'all wow. Hey, this a Google inverted head and shoulders. I think this one did what it was supposed to do. But yeah, just to give you an idea of when we call these in the group. Let's see, double bottom. Let's see if we got any with the charts. You calling them, but I don't see the. And we got plays where you made 468 off of that one, but I'm not finding any with the charts. This is how I
Yeah.
find it.
I think you was the only one that posted with the chat.
There you go. There we go. Now, that's an inverted shoulders, head and shoulders for your ass.
Yeah.
We made bread off of that one too. What receipts at? Sold my McDonald's, and I sold it early too. Cause I posted this after, like we sold it like right here. It kept going. That one So, had to shake that boy hand on that one. Yeah. We sold here, but see how this go. I had this drawn out, and Drake could tell you, man. When I started realizing I can do this shit was crazy because I used to see people do it, but I never really thought like until I really understood how the market worked. It was up 288. I think I got up a little bit more than that before I sold. But it kept going. This here is the Amazon. This was drawing up well before it got here. And I want to say we exited this play before then. Before it made the full move. But that's the bull flags that we talking about. When we get to when we making plays like that, 124, where was it at? 121. I sold Amazon. Sold Amazon last week after charting this, and look what it did. Gotta trust the process a little bit more. Sold Amazon at 860 profit before it did that. Before it went and made that full move. But that's what I bought it based off of. Catching it here and going up. Then we sold it and it kept going. I do that shit to myself a lot. I'm trying to get out of that, but it's a part of the game, man. It's part of the learning process, but we're getting we got some flags that be in here. This was a bull flag on Meta. I'm pretty sure this did what it was supposed to do. And see, we posting it in the group to show you when they break out, where they supposed to break out from, our entry points. I can't wait till we get back to these days. God damn, bro. That shit was sweet back in December, January. Trump killing the market right now, dog. It's he making it hard for us, bro. But this is the time you want to get into the market, though, man. When everything falling, the way that it's been falling, everything just getting cheaper and cheaper, and those companies ain't doing no worse than what they was doing. It's just a lot of shit going on, so we got to go through it. But when it turn around, man, I'm telling you, this shit gonna be different. Y'all ain't seen it when the group really be popping like every day. We end up smacking for real. Like, y'all ain't really seen that side of it. Because since a lot of y'all that's in here right now been in, it's been a rough market. You know what I'm saying? So, fortunately, Drake been killing it with Tesla. Like, he been on it because that was something that, and I told him that a little while back, bro. You really know that stock. Like, so lean into that. You know what I'm saying? And that shit is paying off for him now as we going through this rough patch in the market. But I'm telling you, when they find footing and we get a good story and understanding of where we going with this, aside from all the tariffs and all the bullshit, all the companies get to where we understand what we doing with AI. This is what it is. This is how we finna be making. This shit gonna get to rolling, man. And we'll be right back to it. But yeah, that's a little bit of our patterns. This I made these personally myself. These right here. And I want to put out like a book, or I probably will do it for a course, like as a course for y'all, and then I'll put it together as like a little book or something like that. Throw on Amazon. But this I think will help y'all out a lot. It'll give you a visual versus just saying what it is. And then also on these pages, I had it where I explain how you enter and exit those trades, where the volatility comes in. While I'm talking, I'm gonna try to bring one up on the other screen. What else was on that? Using entry and exit points. That's mainly what we're using those for. Setting stop loss orders, which you can't do on Robinhood for options, but you can set a mental stop loss. When it gets to this point, you can set an alert for that price point, and when it gets there, you can cut your losses. You know, you got your losses already mapped out to where this is where you are willing to cut your losses, and because if it gets here, it's a failed wedge, because this is a falling wedge. If it gets here, it's a failed wedge, so it's not actually making that formation that you thought you saw. Uh, let's see. I'm gonna bring it up over here. Chart patterns. Yeah, here we go. So yeah, I was working on these full breakdowns on entry, exit, the breakout confirmations. That's the one for the inverted head and shoulders. I break down the description, the significance, and I think this, once I get back to actually doing this and finish it out, I think it'll really help y'all out, man, with understanding the technicals on a deeper level. The double bottoms, your stop loss here, your first take profit. Like I was saying, you take profit here, and you can let it bounce and take profit again, or you can take your whole position, let it bounce, enter again, and then take profit here again. But yeah, I gotta get back on those, man. I keep saying that, but seriously, I think that should have helped y'all out a lot, because it gives you a full breakdown of how to visualize those chart patterns before you start seeing them on the charts. I think we got like 2 more pages and then we'll be done. Just going over the few indicators that we use. The top indicators that most technical traders use is those moving averages, which is your mainly your 20 day, 50 day, and 200 day moving averages. Is these lines. I keep it as a bold line on my screens. On my charts, I keep a 200 always on there, bold. That's the average, the 200 day moving average based on the price. That's where it's been at on average over the last 200 days. So it don't move exactly with the stock price. It's basing it on an average over the last 200 days. The same thing with the 50 and the 20. The 50 and the 20 move closer to the actual price because it's less data going into that. Like within the last 20 days, it's pretty much been within this range. So it'll be a lot closer. The RSI, this is probably my favorite indicator, because I catch these bounces so much coming off the bottom, mostly coming off the bottom because we're bullish, we're bull traders. So you'll catch me saying, especially GEV. GEV in the RSI is like my favorite pair. I put, because GEV gonna respect that RSI like 9 times out of 10, man. You'll see GEV in here all the time. Well, we are calling GEV at the bottom. GEV coming from Google. That was Google coming from the bottom. GEV coming from the bottom, bouncing off the RSI. Bullish divergence. Coming down here, coming up here. Bullish divergence. Down here, up here, GEV. GEV. $500 GEV. We killing GEV. Sold GEV 210, 220, 180. We got some big GEV plays too though. Some like 1,000. But I even got Hunter on GEV. He be watching it closer than me. Now he'll tell me when GEV finna do something. So yeah, that's the RSI and the moving averages. That's the main indicators that we typically use. Drake uses the TTM squeeze. I can't tell you the first thing about that because I rely on Drake for it. He knows that indicator, so I hit him and be like, hey, this is what I see on the RSI, and this is what it's doing, and this is what's going on the fundamental side. What you seeing on the TTM squeeze? Once all that shit come together, it makes too much sense to get into the position. Just like with the Netflix play, that's how that happened. It was looking good on the fundamental side. I was looking at my indicators on the technical side, and Drake confirmed it with his technicals. We in there. Indicators into options trading. Confirming signals. Use indicators to confirm signals. Yep. Use the indicators to confirm those patterns. Like when you see them patterns of a wedge or all that, and it's oversold on the RSI, and it's rounding up on the TTM squeeze, and when all that shit start pairing up, that's when you load those positions. Cause it's gonna do what it do. You just gotta give it time.
Yeah, that's what we call confluences. Once you have 3, 4, 5 different confluences, you got a 90% chance that you're gonna make
For
some
sure.
bread.
What's crazy is right now we just be picking up scrap because the way the market is right now. It's hard to get those to be all paired at the same time because of the volatility in the market right now. But it's
Yeah.
going.
And when I trade, I'm just looking at two. So think about when you get, and right now I'm at a 1% of over 80%. So think about once you get 3, 4 confluences all at once. It's go mode. It's big
Mm-hmm.
money.
That's what I mean by when the market get back to that type of sentiment attitude, we gonna get to really smacking it here. Right. But yeah, that's about it on chart patterns. We'll get deeper into that. I gotta get some more content on that for y'all. Risk management is the last one. We talked about this throughout the entire time. I do want to break them three down, but outside of those three, yeah, we're gonna finish off with these last slides here. The types of risk, and then the realistic expectations. I think that's it. After that, emotions, key concepts, and frequently asked questions. Yeah, so that's it. After types of risk, you got your market risk, where you got losses due to market fluctuation. Liquidity risk, where you don't you are like when Draco say his order didn't fill. Um, Sometimes that's due to like the price fluctuation or it not being enough seller contracts in the not volume. Sometimes rarely with his is volume. Most of the time with his it's the fluctuation of the price because he trading some extremely high volatility. But also volume. Like you can get into a contract, and this is a mistake that I was making early on. You gotta look at the volume and how many people are actually trading that contract. Cause if there's no volume there, it's gonna be hard as hell for you to sell it. Even if you in profit, if you in profit, you're gonna have to take a cut on your profit to sell it back to the market if there's no volume there because they don't have nobody else to sell it to. So they'll take it back, but they ain't gonna give it to you at the price that you would probably get it for if it was more volume in that contract. I had to learn that the hard way. I learned that the hard way a few times until I understood that earlier on that you gotta watch the volume in contracts because if the volume is like 0, 1, 2, you don't need to be trading because there's too many that you can be trading that have higher volume, that got crazy volume. You ain't gotta worry about if somebody want to buy it. It's standing in line to buy it. So, uh, assignment risk, the possibility of being assigned on the short option position. Y'all don't need to worry about that because you're not playing shorts. Y'all don't need to worry about that. Playing shorts is a whole different ball game. That's not even regular, just options. That's shorting a company. Mitigate risk, be diversified. Don't all be in the same sector. Don't have six contracts, six positions, and they all in the tech sector. Cause if the Qs go down, your whole damn screen gonna be red. But if you diversify a little bit, I'm talking like swing traders. Now day traders, you can't be but so diversified. But when you doing swings, you wanna be in different industries, different sectors. So if industrial's doing good, tech doing bad right now, or these few days, you know, you can average into those tech positions while you watching your industrials and your retail cook. Position size, and we spoke on that about averaging into those positions, not dumping it all in at once. Setting realistic expectations. That was what we spoke on. Like, don't go and buy a contract for next week that's out $100, unless that stock moves $100 in a week on average. That's set realistic goals for yourself. Don't look at what you can make off of the position, but look at what's more likely to happen. You know what I'm saying? And once you look at it that way, what's more likely to happen versus what you can make, you'll be a lot better off. Because if you're looking at it as what you can make, if it doesn't typically do that, then it's not likely you're gonna make that anyway. So look at it more so as what that stock typically does, how it flows, and set realistic goals for yourself. You know what I'm saying? And start small, work your way up. Regularly evaluate, adjust your goals based on changing market conditions. Again, that's how I adjusted my trading strategy from now to the longer swings, because I'm being realistic. It's not likely for these stocks to make these moves in this type of market that they would typically make. So buy it out. Jake could tell you, I don't usually buy to the end of the year, or I don't usually buy that far out. Every now and then, but majority of the time, it's a couple weeks to a couple months, not 5, 6, 7 months down the line. But the market that we in right now, that's kind of what I gotta go with. I'm being realistic. You know what I'm saying? Not going with what I want to happen, but what's more likely to happen. Manage your emotions. It's gonna take you down through especially if you get to playing this game on a high level, because you gotta lose 1,000 to make 2, 3, 4, 5,000. You gotta lose 5 to make 10, 15, 20,000. It just happened like that because the reason it happens like that is because as you grow, you're gonna be able to risk more. So you can't look at the number. You gotta more so look at what you're able to risk. Only risking what you're able to risk and what you should be risking using your proper risk management. If losing $5,000 look a lot different to somebody that got $10,000 versus somebody that got 100. If you got $100,000 account, you lose 5, you only lost 5%. You got 20, you lost 5, you just lost 20, you lost a quarter of your account. If you got 10, you just lost half of your account. 50, it's equivalent to somebody with 100 losing 50 bands. So control your emotions. Understand it's gonna take you through that, and when you get to those lows, understand that this is a part of the game, and you're just going through that part of the game, and you learning from those lows and learning from those down times, especially if everybody down, like the market. If the market down, and like I said earlier, billionaires losing billions, you can't be tripping about losing a couple grand. Like, that's just what it is. Like, it's a part of the game. Either you want to play it or you don't. Techniques for emotional. Develop a trading plan. This helps with, if you got a plan, you can know why it went wrong. You can know why it went right. You can know what you need to do to change it, make your tweaks the next go round. Practicing mindfulness techniques such as meditation, maintain your focus and reduce anxiety. I would recommend that regardless of whether you trading or not. Like get some time to yourself and stop. Don't cram yourself with always thinking about the market and what's going on and none of that. Cause it's gonna do what it do, regardless of whether you stressed or not. So, let it do what it do and understand where you going with things, have a plan, and do your thing, man. Take breaks, step away if you need to. Come back a week later. Key concepts. That's basically a lot of the stuff we already talked about. Split straights. It's everything we talked about. These are frequently asked questions, but I'd rather y'all ask me any questions you have. I think we went over a lot of the stuff that we needed to go over. We went over everything we needed to go over in this course. Um, if you all have any questions, then just let me know. Let me, Drake, Hunter, Sam know. We'll get you up to speed on everything, man. I try to be in there as much as I can answering any questions, but I'm busy throughout the day. So when I do see it, I definitely get to you, or hit me with a direct message. I get to you faster. But other than that, this all a community, dog. Like a lot of the people in here, they've learned enough to help others without me and Drake even stepping in. So, if you got a question about something or you need to get up to speed with something, anybody in here that's been in here for a little bit can pretty much answer a lot of the questions that you have just getting started. So that wrapped it up, man. You got anything, Drake? We'll close it out for the night.
Hold on, can you hear me? Oh yeah, yeah, my bad. I thought I was muted. No, no, no. Shoot, I like how everything went. We covered everything. And for those, they already wrote me on Facebook. So we'll go ahead and start getting those Weeble accounts set up. I'll send y'all a link tonight, and we might just get them finished up in the morning and show y'all. And I'll be free in the morning to show y'all a couple of things, and we'll get started in the morning.
For sure. All right. Let me see if I
If you don't have my number, just hit me on Facebook. I'll send you my number, and or we can just chat on Facebook, either or.
All right. That's a bit, man. I'll holler at y'all tomorrow.
All right. I'll see everybody tomorrow.